Good morning, everybody. Thanks very much for joining us. Thanks also for Stefan and the team for hosting us here. Fabulous views. I could see where I landed and the train I took and also how I walked here, which is fantastic. And great from being, for the last 3 weeks, in a very miserable and rainy London. Fantastic to see that there is sunshine somewhere else in the world. Debt financing has been a real key part of the discussion, part of the news lines that we've been seeing over the past few weeks with the interest rate rises and changes. So this is really a chance to have a look at where we are in the market, where we see that heading for 2023. And we've got a really interesting group of panelists here coming from different perspectives in the market. But I'm first of all going to hand over to Irina here from INREV. And Irina's going to give, which I think is literally research that you've just finished last night. So a sort of update on the view on debt from Irina. So if we could welcome Irina, that would be great. Thank you.
Okay, good morning. Talking about European non-listed real estate debt, I will focus on the non-listed part because that's what we do at INREV. But before I talk about debt, I want to talk about what's happening in the equity markets first. And this is the research that Richard has mentioned. We just released our European fund index this morning. And as you can see, the Q3 results are already coming in negative, quite sharply actually, given it's a pan-European index. Minus 1.6% is the performance, of which close to 300 basis points is the capital growth decline. And actually, if you break it down into different markets, some, such as UK in particular, are moving much faster than that. So that's a clear direction of travel. If you compare and contrast to the global financial crisis, it's a little bit difficult to speculate right now what degree of the correction will be. Probably won't be as much as the global financial crisis, but there will be a deep correction in the foreseeable future. What we also see is it's happening faster. And I think part of the reason behind that is I think there is no reluctancy to correct and take the hit in the same way as we have seen during the financial crisis, because the level of gearing is not quite as high. If you look at the red line, which illustrates the average level of gearing in the index, and we're talking about more than 330 funds and more than 500 billion worth of assets here. At the peak or at the end of 2008, it was close to 40%. Now it stands at just over 21%. So that's good news, I suppose, in the current environment. But what does it mean for the debt funds? I mean, we have to recognize that we are now moved into different interest rate environment. And even once the corrections come through and the markets are starting to recover both from the economic side and the real estate fundamental side, the interest rates will be normalizing to above what we got used to over the last 10 to 15 years. And that means, in some ways, on the risk-return profile, debt strategies are becoming attractive. So linking to what we have seen from the capital raising perspective over the last few years, in 2021, when we look at all the capital that was raised for European non-listed real estate, 12 billion was for debt-specific strategies in the non-listed space. That's a record high. But I think going forward in 2022, when we get these numbers and in the near future, those numbers are likely to go up further in the non-listed space. And that's already a message from the marketplace when we speak to them. So let's talk about structure a little bit, just to give you context. If you think about size of the lending markets, of course, the US market is the largest, the most mature, and much more diverse in terms of composition of lenders. It's because of its size, the kind of debt, private debt side is only about 3% of the market, but insurers play a large role, and there is lots of diversity with agencies involved and the CMBS part. When we think about UK, that's a much smaller market, but the space that the non-listed debt funds have taken has already been quite notable. It's now accounting for about 10%. And actually, the latest studies by Bayes Business School revealed that in the first half, which is known by the Montfort University, most of you will know it, it's been running for decades now, revealed that in the first half of 2022, the non-listed debt new lending has outpaced that of traditional banking. And that's for the first time on record. So I think that is a direction of travel that we are expecting. And for Europe too, Europe is, in terms of non-listed space for that, is evolving. It's behind the UK, but I think the current market circumstance will accelerate some of the trends, particularly on the senior side of things. And I'll talk about that in a minute. So this is the universe that we cover at INREV, the European Debt Vehicles universe. You see the left chart, number of vehicles, and the one on the right is actually the target equity. And over the last 6-7 years, the space has doubled effectively. So it's now close to 100 vehicles and 60 billion worth of assets. What is interesting there is that majority of the vehicles are close-end in structure. That has been the case in the past, but also if we look at the recent launches in the past 2-3 years, and also some of the initiatives that coming through from the regulatory point of view, the closed-end structure is the vehicle of choice. In terms of actual loan type and loan generation strategy, what we are seeing is there is a lot of senior lending out there. Quite a notable proportion is pure senior lending, and then significant proportion is also mixed lending, which is mix of senior lending and then subordinate and preferred equity or just subordinate. But broadly speaking, about 87% of the universe is in that senior or mixed space. And I think given the current market conditions and where we are moving in terms of the opportunities to get risk-return profile, senior is going to be the choice going forward. When it comes to loan generation strategy, we have direct lending, which is quite a notable part, or both. The loan acquisition segment is still very, very small, and I think it just is a function of quite a small market as well. So no surprises there, I suppose. What is important to highlight is those funds which are specialists in senior lending are larger in size. So they tend to be about 650 million on average, and that's about quite a bit higher than about 470, 480 average in the overall space. In terms of structure by country and sector, the same as actually in the equity markets, we've seen that in the non-listed real estate equity market, we see that in the non-listed real estate debt space. When it comes to country, multi-country segments dominate. It's about 70% of the universe when we look at the target equity. And of the space, which is the single country, no surprises there, UK is much more prominent there in that space. When it comes to sector strategy, well, actually, very vast majority is multi-sector. Almost all of the funds that we have on record are multi-sector. And those that are not are in residential, either pure residential or residential development. And I think that's where, on the development side, that may be where some of the stress will be coming through going forward. Talking about stress, maybe a little bit of comfort to those who are in the non-listed real estate debt space already. If we look at the planned termination across the 80 vehicles which are close-end in structure, most of them are, we don't have actually terminations, many terminations at all in 2023. And then there are in general somewhere between 5 and 7, which are due to terminate over the following next 4 years. They also have, majority of the 80 closed-end vehicles have a provision to extend. So there is a little bit of comfort, and then there is a buffer in terms of timing when it comes to the termination pipeline on the non-listed real estate debt fund. I'm not saying our data is perfect. I think one of the functions of this space is that intransparency is a huge issue. And I will talk about that, particularly on the mezzanine side. I think the information on the mezzanine side is very intransparent. So what does that mean? Well, I think if we go back, the kind of emergence of the non-listed real estate debt funds in Europe has happened as the market opportunity opened up after the global financial crisis. It took some time. It started to really power charge in the UK in the last few years, but also in Europe. And the servicing of the financing gap that is left by the traditional lenders is really what the space is catering for. I think it's offering an attractive risk-return profile and also a very healthy diversification for the market. So the lending market space should be diverse in terms of lender choice, makes it more competitive, makes it more healthy. You probably will hear later today about the focus going forward, given where we are in the market. I think the shift towards senior we have already been seeing for the last year or two. Even in the mixed loan strategies, I think we have seen shift towards more senior space. I think that is to continue and be even more prevalent. The other opportunity is, well, we need to remember that for now, it's still an unregulated market. And I think quite lots of advantage has been taken from that by the participants on both sides, just because it's faster to transact. The regulatory and reporting requirements, are not strict there, so you can execute faster. But the regulators are starting to recognize that this is a growing space and starting to kind of look into what needs to be done. In particular, lately we have a proposal, a revision to AFMD for specifically non-listed real estate debt funds. One is that if there is a sell-on of the loan, the proposal is that the seller should be retaining about 5% of the economic value. And the second one is if the fund generates more than 60% in loans, it should have closed-end structure just to control for liquidity issues, just so there is no crises that we have seen in the past. And it's about treating and protecting investors equally. I also think that the non-listed real estate debt has an opportunity to step up into the ESG space, because the commercial real estate in Europe is under lots of pressure to decarbonize, and the traditional lenders, they're not. It's not easy for them to move into that kind of repositioning space in terms of reporting and regulatory perspective. So again, this is an opportunity, a strategic one, for the non-listed real estate debt. Talking about transparency, or rather lack of, I'm just going to give you an invitation to look into INREV Debt Vehicle Universe, which is a database of debt funds, which includes information about fund characteristics, such as loan strategy, size, domicile, vintage, and so on. It is really your window to investors, because INREV is an organization for investors, large and small, and we are there to provide transparency and standards, so it's easy to provide information and get that access to investors. It does not contain sensitive information for that reason, just to make the data provision easy, and you don't have to be a member of INREV to contribute. So what I'm really inviting everyone in the room, because you are engaged in this space, is to encourage your business partners and yourself to be part of this important initiative of getting more data, getting better understanding of the market. So in the nutshell, healthy evolution of the market, more diverse lending space, growing, and I think the current market conditions will accelerate some of the segments of evolution, particularly on the senior side. UK is in the lead. Like I've mentioned, we had non-traditional lenders coming through as the bigger share of the market in the first half of this year. It is an opportunity-driven market, so it's non-uniform. It's not regulated yet, and it's relatively early in the stages of evolution. What it means is understanding it is tricky, and I think there will be more innovative solutions in the marketplace in the next few years as well. Watch out for AFMD. I'm not saying the proposals are final. They're still very much in Brussels. They can be revised and changed, but I think that's something to keep in mind on, because I know that some of the managers were looking into launching open-end structures or semi-open-end structures when it comes to non-listed debt vehicles, so maybe it's something to watch there. But also European taxonomy, I think there's a component there to be mindful of. And of course, the opportunity to continue to serve the financing gap that was created by traditional lenders, but also the strategic opportunity when it comes to ESG-focused debt. Mezzanine segment is less transparent, so I hope to hear a lot more from the panel on that segment of the market. And as a result of the lack of information, measuring performance is quite tricky. I think there's very different structures out there and approaches in the evolving market. So I think there's also an interesting discovery there for us to be having in the next few years. So I think next few years will be interesting, some stress, but also quite an evolutionary, which is an opportunity for us. Thank you for listening, and I hope it's helpful for the discussion.
Great, thanks, Amina. Super, thanks very much, Marina. If you take your seat there on the panel, that would be great. And panelists, if you could join us, that would be great. It doesn't matter where. The only instruction I have is that there is one microphone between three here, and there is one microphone that I have fashioned for you for the three there. So if you take those. And let's maybe start. We've already had an introduction from you, Marina. So let's start with you, Deborah. Just a quick introduction of yourself and the company, and then we'll move down, just so that then everybody here in the room knows exactly which side of the fence you're on.
Sure. Good morning, everyone. I'm Deborah Sobel. I'm half French, half Swedish. I am based out of Paris. I've been working in real estate since I graduated back in 2005. I started off on the equity side. I've been at Allianz Real Estate since 2013 now, where I joined our US team at first on the equity side and then transferred back to Paris and started off on the debt side early 2016. So I've been part of our origination team for our European debt team since then, and now leading our Munich hub for originations for European real estate. We're focusing on the senior space only.
Great, John.
Good morning, everyone. My name is John Krant. I'm 100% Dutch, but I live in Germany since 20 years. Salux is, we are a real estate bridge loan fund. We do bridge loans only for residential assets and property in Germany, and senior only. So as opposed to most mezzanine players, we need the first rank. The key differentiator is that our loans are maximum of 12 months.
Okay, great. Oliver.
Yes, good morning, everyone. Great you made it safe through the railway district this morning. So yes, I'm a managing partner with Asida Advisors. Asida Advisors is a fully integrated distressed debt, loan servicing, real estate asset management platform. We are working currently with one key client, which is Nexum Debt Potential Funds, a Luxembourg-based 300 million equity fund, which is, other than Salux, not providing new lending, but investing in debt opportunities with a focus on potential NPL transactions in Germany, in the wider DACH region. We are also working for Davidson Kempner, which is a UK and US-based private equity company on their NPL and loan transactions in Germany. And right now we are looking, or we are in due diligence for 3 NPL transactions in Germany. So NPLs are not a fairy tale, just to say that up front. I look at lots of familiar faces, like at every debt finance panel. So I started my career in finance back in 2004 as the head of legal for Hudson Advisors, the loan servicer for Lone Star, and Hudson is like a pool of talent for everybody in the industry. So I see many familiar ones.
Great. Stefan.
Hello, good morning. Stefan Stamm, partner of Norton Rose Fulbright. Norton Rose Fulbright is a global law firm with 3,500 lawyers worldwide. Full service law firm, but with a particular focus on financing and real estate finance in particular. Personally, I'm in the space since a little less than 20 years now. Bad thing is you're getting old, good thing is you went through all of this, as Irina showed in her presentation 20 years backwards. All this you have seen when you're of that age, basically. Doing origination, securitization, syndication, and restructuring of all kind of asset classes, international as well as national, including also NPL and the sweep up of all that stuff we had post-Lehman. We don't see this time round, but we see different things, and that's what we're talking about today, I guess.
Great, Assem.
Hi, Assem Alalami. I'm heading the International Origination Group for Berlin Hyp. Berlin Hyp is a traditional lender, balance sheet lender, senior lending. We're active in Germany. That's roughly 70% of our activity, and 30% other than Germany is France, Benelux, Poland, and Czech Republic. Yeah. Well, I've been in the business for almost as long as you have, so roughly 25 years, and I've seen this, but I think the big difference between the last crisis and what we see today is that I don't see that the senior lenders are in big troubles. I think there are other lenders which are maybe under a bit of stress and making you happy, maybe. So curious to see how the private debt and the alternative lenders will manage this situation.
Okay, good.
Rockstar mic.
Yeah, you could. Oh yes, hand back the Rockstar mic. That's true, because you've got that one there.
Oh, yeah.
Assem, let's just start with you. Just in terms of, you mentioned there some of the differences between Lehman and now. So I suppose, what are those? How do you see that? And do you think there will be less sort of extension? Do you think there'll be, and are organisations like BaFin telling the banks what they have to do or advising them? What's the situation? Is it, how different is it to the previous crisis?
Well, can you hear me? Yeah. The situation is different due to two influences. One is the regulatory difference, increased capital ratios, and that's been quite healthy for the market. And the other reason is just simply the commercial policy of banks, which have not been seduced by big lending volumes and high leverage as in the last situation, but have been quite disciplined when it comes to leverage and seeing private equity in the transaction and equity full stop in the transaction and relatively low leverage. When I look at our loan book, we're probably our loan book stands at an average of somewhere around 50 to 55 LTV, which I think is relatively resilient, even in the light of the current environment.
Okay, good. Yeah.
What we see not only from the banking side, but from the economy. This crisis, other than GFC, has not only one cause, but multiple causes. So it's the war in Ukraine, COVID-19 as the black swans. We have rising interest rates. We have changing environments in office users. So lots of people want to go home office. We have changes in the behavior of buying, like people buy not retail, they go to Amazon. And this all puts pressure on real estate because the tenants are underwater. We might see more insolvencies starting next year. So I just read something this morning that we expect a rising of interest rates, insolvency rates in 23 of 71% in comparison to this year. So I guess we have multiple causes for this crisis. in comparison to GFC.
Okay, good. Yeah, go ahead, Deborah.
Maybe
Yeah.
on that topic, I think the difference is that, I think post GFC lenders were sitting with loans yielding 120, 130% LTVs. I think now that people have learned the lessons, a 50-55% LTV portfolio may lead to a 70% LTV portfolio in a few months. And what that means from the lender's perspective is that they can still get their money back, right? So in a way, I think banks and lenders in general will be more demanding towards borrowers. And if the borrowers are not ready to inject the necessary equity, then they'll be pushing them for sale.
Okay, good. And picking up that point from Asim around the senior lenders in general in a good position, does that mean by definition that the MES lenders are not? Does anybody want to pick that up? Is that where the stress is going to be mostly seen?
What we've seen is basically a lot of loan requests that are coming in right now have a high MES structure, right? And the current evaluations that are kicking in, nobody knows how big they're going to be. But if you have lent above 80% as a MES lender, basically, you have taken some of the equity risk, right? For a 10 to 15% interest rate. Now, the equity risk is kicking in. So some MES lenders, of course, they will have a haircut next year. We expect quite a consolidation there.
Okay, good. And Stefan, I suppose just coming to you, what are you seeing at the moment? I mean, we had various discussions around debt where we were looking, more towards, I suppose, there being less in terms of non-performing loans, the stress coming through. What are you seeing now? And I suppose, are you looking at that as something that's accelerating at the moment? How do you see the market?
Yeah, I don't know whether I would be that bullish as some of you here have been, but there is definitely not such a deep dive like we had it in the financial crisis. But as there are multiple reasons for that, there are still many things out there to be clarified for the market, and prices need to adjust, and that will take time. That won't be in Q1. Perhaps in Q2, if you ask me, I would bet next year round we will be busy, but I don't know when it really starts. Currently, we have already some insolvencies to deal with. That is, I must confess, kicked in earlier than I expected. I expected that for beginning next year, but as Irina also pointed out, price adjustments might take place faster than last time round, but still due to the multiple causes of this situation, it will take time. So far there are much less originations, quite some originations, but these are implementations of decision making processes started early this year. And the insolvency and restructuring business comes in. In some financings, we see new MES financing on the shareholding levels, but also on the SPV levels to be integrated into financings where money is still not there due to the pre-crisis calculations. So that's it.
Okay, good. And Asim, I suppose, coming to you, obviously there's a big focus at the moment on construction loans, development loans, because they're seeing a slightly more different, because there are, there's a rise in construction costs, there's issues with the interest rate rises. Do you think that's the area where there's going to be sort of most stress, I suppose?
Well, I guess when we just hinted at some problems that mezzanine lenders can get into, we were actually indirectly talking about exactly that field. So there are a lot of, let me say, there's a lot of equity stretch through mezzanine lending. So when we talk about mezzanine lenders, those are in particular those who lend against construction. Yeah. And that's, yeah, well, I don't know how it will work out, but probably the combination of rising yields, rising construction costs, and rising funding costs will eventually cause some stress on that sector.
Okay, good.
And I think, if I may add, that there's a huge difference between financings on project developments currently having to be refinanced and financings on existing properties. I think most of the existing properties are doing fine, even with 10-15% devaluations. But the basic problem for the project developments we see now is that they are no longer profitable anymore. The bulk of them are not profitable anymore. Now, the project developers therefore face the big decision to start building and risk very high losses, or write down the assets, write down the property. And eventually, if they can afford to write down the property or keep it, and they have a refinancing coming up, a lot of properties will change hands. But there will be quite a market shakeout, I think, and consolidation in the project development landscape.
Yeah, and to add to that, lots of those project developers, they have already signed forward deals, and in those agreements they have obligations to build, and they have to build those constructions with the purchase price they receive from the forward deal, and now they are under deep stress.
Okay, and
Having said that earlier, with regard to insolvencies, all the insolvencies we are currently dealing with are insolvencies of developers and construction firms, and that there's a lot of work to be done. One good thing, though, is that there are still many players on the equity and debt side of the market who have dry powder and are willing to invest. But as said beforehand, the situation needs to be cleared up and prices to be adjusted. But once this has taken place, there will be again a lot of business.
And we're not talking about Project 4, that's too big to fail, they will get their refinancing, but we're talking about SMEs and small developers. And there we see lots of them being underwater right now, as we speak.
I was going to say, at least from Allianz Real Estate perspective, I think for the right project we'll still be there on the construction and lending side. I mean, we have two mandates, one is our core mandate and one is our value add mandate, which includes construction loans, and the allocation between those two mandates is 50-50. And one of the main drivers for us lending on construction loan is for us to be able to also reach our ESG targets, the company's ESG targets when it comes to, reaching a carbon neutral portfolio by 2050. So, independently of how much capital we'll have to deploy next year, I still strongly believe that we'll be deploying, 50% of it towards a value add type of project.
If
okay,
I may.
yep, go ahead, Irene. Yep.
Sorry, just to add on that point around ESG targets, I think it's great that you're doing new finance and in that perspective, but I think we need to recognize that probably more than 80% of the market is existing assets, and actually where the need is, and that's why I really think it's a strategic opportunity, is actually servicing that space in terms of that provision on refurbishing, refinancing, repurposing, repositioning. It is an opportunity for those who might be in position to take it. Is that there as well? So.
Absolutely. I think the big issue, how do banks deal with their legacy book when it comes to ESG ratings?
Yeah.
Right? Another reason to maybe sell off some.
Yeah, can I just answer that? Because when I say our value add mandate, that includes, yes, construction loans on, new projects, future fit, will, tick all the boxes. But I think that also includes supporting the transformation of the existing park. I think an interesting example is, this year we had to refinance one of our existing loans, the Madrid office portfolio, which didn't necessarily tick all the boxes from an ESG standpoint. But the way we approached it was, to try to we looked at it from an ESG angle from the start, and that's one of the main questions we asked our borrower from that end. And the borrower came back and saying, yeah, we're working on it. Our target is to increase the EPC levels of those different assets. We'll spend the capex to get better BREEAM certifications on it. And so what we did is, and this is what we also want, right, is to see some sort of improvements during the life of the loan. And so we actually had the borrower commit in the loan documentation to spending those X million of
Right.
capex in order to improve their EPC ratings and that. So that's
Fantastic.
part of the job.
I think that's a very nice illustration of what ESG actually does. ESG is actually a defensive mechanism to defend your capital value. And so when you talked about the transitional risk, indeed, and then I could tell tens of stories similar to yours, in a good story, where we tell to our clients, listen, your building is brown. We're going to fund the acquisition of the building, but only if you can tell us how you will eventually transform it into a green building or to a more efficient building. And that's, I think, to answer your question, Rena. Yes, the transition and, for example, the repositioning assets. So that will be part of the construction loans that the senior lenders will still be doing throughout the next couple of years, because there is such a huge need. And I would like to add, at least speaking for Bill and HIP, we also see responsibility to be there for that kind of business.
And do you think this is going to be, an opportunity in a way, because there are going to be businesses that will be forced to look at their assets because they're underperforming, that actually it's a chance then to move ahead with transformation that they might not have looked at maybe for 2, 3, 4 years perhaps?
Yeah, well, I was on a different panel, sorry, a couple of weeks ago, and one of the panel members said, well, now investors might invest less into ESG because they're going to put money away to be able to cure breached LTV loans. And I contradicted that, because you can do that, or you can invest into ESG and increase the value and be defensive in that way. And I think that's a more intelligent way to do it.
Yeah.
To be honest.
I fully agree with that. It is. I would think it's other way around. It is an opportunity, of course, to go into, but it's also a huge threat for many properties who are not that stable anymore. Anyway, you can't exit that investment anymore in 1, 2, 3, 4, 5 years. Even now, perhaps looking at the investors who think about their exit then. Without thinking about ESG compliance, and that's a cost factor. So what Oliver said beforehand, it's the crisis has diverse causes, and ESG is one of these causes. Many properties need to be refurbished before being marketable again.
I mean, we saw that all at the European side a few weeks ago. Alone, the Senate of Hamburg needs 32 billion for the residential decarbonization measures in the coming years. It's huge.
Yeah, no, it's a really significant one. One thing I wanted to pick up a little bit, we'd mentioned there that one of the differences with the Lehman crisis is the fact that there is dry powder, which is different to that period of time. Is there a risk, though, that with interest rates rising, bond yields rising, that institutional capital is going to be less willing to go into those debt funds because they see it as more risky? Or, I mean, what's the situation like in terms of, I suppose, capital raising? And do you see investors moving out of that, or do they still see that as an attractive space?
I can take that, but you can.
You can take it as well, Deborah. That's all right. Yeah.
I was going to say, I think generally speaking, there's less capital available. So I think funds that are out there raising, it's definitely more challenging than it was 6 to 12 months ago. But if I was an investor and I still had liquidity to invest, I think real estate debt would definitely be a good space to invest. So I think for the funds that are available, it's better to spend your money today actually on real estate debt than equity. I mean, if you look at what we're getting all-in returns on a very core plus deal today, we're getting 4.55% all-in returns. That's even more than what we're getting on the equity side. So I think from Allianz real estate perspective, I mean, yes, we're hearing that institutions like insurance companies and pension funds, their balance sheet has been hit, and so there's a little bit less available capital for real estate compared to the bond market, which is actually becoming more attractive. But I think from our end, the business model still works the way our investors look at real estate debt. They're looking at the spread over benchmark, and the benchmark is the Barclays A corporate index. And in the same way we're seeing flight to quality on the real estate side, we're seeing that also in the bond space. So the spreads still remain tight. So we still have a spread over benchmark of 150 to 200 bips over, which makes our business model still work.
Yeah. Just to add to that, I think we also need to think about short-term and the denominator effect. Because of course, if you look at the multi-asset allocation, the repricing has already taken place on the equity side, on the fixed income side, and we are lagging. So actually it's to our advantage as an industry, both on the equity side and on the debt side, is to take and reprice as soon as possible, because then we will be on the equal footing when it comes to the multi-asset allocation. So I think that's one. Second one, completely agree with you, Deborah, but what we see is there is no reds, there is ambers. Because of this over-allocation, a lot of investors who would have otherwise be very keen to go into this vintage year, 2023, are kind of not in position to, because they are just over-allocated. But I think where there is more decision-making freedom, so maybe JVs or separate mandates, we see a lot of interest, and I think that money can move into the market fast because they see an opportunity, they know what's coming their way.
Just to add on that, on the distressed debt side, not the private lending side, you see an almost paradoxical situation. So all the investors, they say, yeah, we see there might something coming, that there are opportunities probably in 23, and we hear all your arguments, and I'm always waving around Raimund Rösler's statement from BaFin at the beginning of November, that there will be NPLs, but then there's always also this big uncertainty. They say, yes, we see the facts which are causing the crisis, but also the very same facts are the ones who are making us reluctant to actually invest. So we just wait and see, and then we might go to market and invest when there are actual transactions, but then it might be too late.
Yeah, I think that's the point. The first mover advantage is there right now.
Right. I think that's true for any kind of capital. Also, we as a senior lender, we will probably be a bit more conservative in the first half of the year, because just simply for the fact that we don't know where the right price will be. If we don't know where the right price will be, then we don't know where the leverage will be, then we don't know where our internal costs will be. So that will result in a more conservative stance. Funding costs will be more expensive, because we will have to incorporate some sort of buffer for market fluctuation. So generally speaking, I would expect that, at least speaking for balance sheet lenders, there will be less capacity, less willingness to be very bullish in the market and to be very aggressive about financing. The financing market, at least for the banking sector, will probably tighten up a little bit and become significantly more expensive.
Okay, good. And does that create then an opportunity for the non-bank lenders? What's the situation there?
Well, I think opportunities are always there, right? When you look at the transaction volumes back in 2011 and 2012, where we had the interest rates of 4 or 5%, where we are now, that's half of the transaction volumes that we had in the last 2 years. So we expect that the transaction volumes, the market activity, will be maximum 40-50% of what we've seen in the last years, which also, of course, has the same effect to lending activity. Now, if banks getting more conservative, of course, the funding gap will be bigger. But the question is, if banks do not accept a large part of mezzanine funding anymore, like 30%, right? Because we, for example, we want to see hard cash now. We don't want to see equity substitutes going forward like mezzanine. that it has to be proven if it's an opportunity for a mass loan. I think it's going to be volume-wise much lower. There needs to be a consolidation in the mass sector. On the other side, I think then home loan has a big opportunity to bridge that funding gap, basically.
Okay, and I'd be interested just to get a sense, in terms of the borrowers, what you're seeing. Who's coming to you? Are there less borrowers because they're looking at it and thinking, well, actually, it doesn't stack up for me to use this leverage any longer? Or are they specifically coming to you because they know down the track they're going to have an issue and they're looking for bridging finance? Who's knocking on your door, John?
Well, in the first half of this year, the majority of the requests were acquisition financings. Now, that has changed completely to refinancing requests because a lot of lenders in the market have gone to the borrowers and say, listen, when a loan expires at the end of the year or January, we are not going to prolong our loan. We need our money back. And that applies to banks, that applies to mezzanine funds, to crowdfunding. So they are looking for refinancings. Now, the question is it a project development, what I said before, which is not bankable anymore from our view? We're not going to finance it. Another lender is not going to finance it. So ultimately, that will end up in a stranded asset, right? And that's going to change hands next year. If it's a solid asset, and we still see solid financing structures and solid investors and solid assets, and it's bankable, we're there to finance it.
Okay, good. Yeah, Deborah, go ahead.
Yeah, I was going to say, I agree. First part of the year was a lot about acquisition financing. None of that since the summer. On the refinancing side, I think some smart borrowers saw the rates increase, so they came to us for long-term refinancing. So I think that was probably the smart play. And then I would say the second part of this year, it's a lot about asking for extensions of 1 or 2 years in order to sort of avoid the issue of refinancing and higher debt costs. I think that's going to be pushed back to next year, and that's probably what's going to be interesting next year to see how those refinancings are going to be addressed.
Just to add what John said, I can fully confirm because lots of borrowers now, since the NPL backstop is alive since last June, and the banks, they woke up to the fact it's not only actual NPLs which count, but also loans which are under forbearance measures. So that you can't trust anymore that your bank will prolong for another half year, another year, because this all has puts pressure on your core capital. And this is why they come to John and ask for mass lending with the venture.
And I think one thing not to forget is that I think about more than 90% of all loan contracts have LTV covenants, right? And they're very stretched. And at the end of the year, when the new LTVs come in, we'll see a lot of LTV covenants. Now, nobody is going to open their books and say how many LTV covenant breaches they have, but I mean, the bankers who work in the industry the last 12 years have never seen or never been learned how to deal with a breach of LTV covenants. So that's one question for me would be, how are mass lenders and how are banks reacting to the breach of LTV covenants? Are they just going to waive it, or are they going to the NPL players in January?
Okay. Question for you, Assel.
Listen, I mean, a bank has no interest in pushing its client to either a default or an extension. So usually what will happen is we find a way to increase the pricing, trap all the cash if there is cash, and try to cure the LTV breach through a cash trap or a cash sweep, however you structure it. But then eventually also the question arises, who are you working with? And I agree, I think you said that on the development side, we will probably not see the big players, the big boys defaulting anyway, but the small to medium size. And that's true for the investment community as well. I mean, usually the big boys provide for any kind of stress, and they have equity inject, and then you work it out, or you structure it in a way that you did, as I just described. And only in some instances the cash flow might be affected as well, and then you have a more complex situation, and then maybe there would be one or the other acceleration. But in conclusion, the mere breach of covenants just puts everybody around the table and say, okay, how are we going to work this situation out? It's not necessarily a case where of insolvency or acceleration of security.
Is there any guidance yet from the BaFin how to deal with debt early next year?
Not that I'm aware of.
Stefan, yeah, go ahead.
Okay, I think that's also what we see in our daily work for all the LTV breaches, covenant breaches. The banks don't come to us and seek for advice. That's what they do internally in-house. But what we see is what I said beforehand. There are the stranded assets, which already now in part go into insolvency and will come to that point during the next 1-2 quarters. But there are also the more healthy situations where new debt is being poured in by additional mass lending on the SPV level and shareholding level. And there are refinancings underway, the whole loan instead of senior mass structures. And what is currently already in the thinking again, like 10 years ago, where it was the last time this has been discussed in the German market, Islamic finance lenders are coming into the market again. Higher soft costs, but if there is money needed, they would be willing to go into that if all parties agree to that. So that's an alternative, what we see. And what, looking forward, what I also think there have been many players in the European market who have been always interested in the German market, but didn't get the yields and the margins they were seeking for. They went to Italy, Greece, Spain during the last 1, 2, 3, 4, 5 years. They might come back to the German market and find the conditions here getting more and more interesting, and that's an additional source of money which might help the more healthy.
I've got 2 last quick questions, and then there'll be plenty of opportunity as well for private conversations with the speakers afterwards over coffee. One is geographies. We've talked a little bit about some of the sectors that may be more, I suppose, influenced by this situation. Does that also count for geographies? Are there going to be particular markets that are going to be worse, whether that's CE, whether it's UK, whether it's Germany, whether it's other areas, or in general, are you not looking at it in that way? It doesn't really change your risk profile as a lender, let's say, to the lenders.
I'll answer that question 2 ways. I think one is what's preventing us right now from lending is the lack of visibility, right? So I think the markets where there will be a quicker adjustment in the values, and that's probably the UK, if I had to guess, that's probably going to be the markets where activity will pick up earlier. So maybe in a way, that's where we'll see a bit more financing asks. From Allianz Real Estate perspective, we have built a very diversified portfolio geographically. We went from 10 years ago being only Germany focused, then Germany and France like 50-50, and now we're present in 12 different jurisdictions in Europe with exposure to France mostly by 25%. The UK second, and Germany is actually decreased down to less than 20%. And one of the reasons for that is the cheap returns that we're getting here, so we'll be very pleased to come back to Germany a little more. And then the other jurisdictions are, more or less from 5 to 10%. So we'll continue being active across jurisdictions in Europe.
Okay, good. Same for you, Assam, as well.
Well, 2 remarks on that. For me personally, it's less a question of jurisdiction. I mean, there are some markets which we are not active in, but that's a different subject. But rather sub-markets. For example, speaking for German, where you could say on a general level it's quite solid. I have to say I'm a bit concerned about vacancies in Düsseldorf or Frankfurt. When it comes to Paris, Berlin, Munich, those are very solid markets. So it's rather a question of local market rather than country geography. On the other hand, I learned very early in my banking career, there was a citation from an early 20th century banker, Mr. Rothschild, who said, "I don't lend to stones, I lend to people." So that actually the decisive element will also be who's your partner, who are you teaming up with, and for the time being, we seem to be teaming up with right now.
Okay, good. And this is a general one for everybody. Is how long? I suppose we're looking towards 2023. As I remember it, after Lehman, there was very little liquidity, very little, actually, for a long period afterwards. Do we think this is going to be significantly shorter? When do we think things? Do we think this is going to be a 6-month thing where things begin to come back? In Q3, and there's a rush in Q4. How do we see that, or do we think everything's going to be back again in Q2? What's everybody's sense of where we see the market going forward? Big question, I know, but
Who wants to start? If I had to guess, no crystal ball, but I do think that for sure the 6 to 12 next months will be quiet on the investment side, so not much of acquisition financing I would anticipate. I think what will be interesting, as I mentioned before, in 2023 is all the refinancing asks. And I think from a lender's perspective, it's a very good time. It's a very good time to lend at returns that will be interesting for our investors. And I think that from our end, we focus on very large tickets. Average size of our loans 200 million on average in Europe. So we are hearing already some of our competitors retrieving from those larger size tickets. So I think we'll be in a very good position for the large size transactions next year.
Yeah, it's pretty much the same. We don't have a crystal ball. We choose to work in an industry which is highly illiquid, highly intransparent. We used to live with insecurity. Now it's a large amount of insecurity. As Ollie said, there are a variety of reasons for insecurity as long as they persist and not all go away once and all. Nobody can really predict how long this is going to take. But what's for sure is that the next 6 months is going to be subdued transaction level and lending activity level. That's for sure.
Okay, good. I'm going to do one last question to all, which is, given where we are in the market, where are the opportunities? Because we like to be positive. So where are the opportunities for it? It's heading towards Christmas, isn't it? I mean, we've got to be positive. So where are the opportunities in this market? Who wants to start? Why don't we, let's start with you, Asim. You're almost raising your hands there, yeah.
I'm going to be really boring. The opportunity lies in the safe havens. And one of the opportunities I see for balance sheet lenders is that the bond market has become really expensive and that we have REITs and other institutional borrowers turning back to the banking landscape and remembering that we exist. So that's what we see.
Okay, great. Stefan.
Yes, quite similar. It's more about the shift within the market. It is from the debt capital market again to the bilateral lending sphere. It is, as I said earlier, international players who didn't go to the German market due to the low margins. Yields are coming back because it's getting more interesting. It is several players we had that who have been invested in CEE, for example, during the last years. They get from their investors and supervisory authorities that they should shift their money from the, relatively speaking, higher risk area CEE back to the safe havens, Germany, Netherlands, France. So they will come to Germany. So Islamic finance sources. So there are various shifts within the market, but the overall levels for new transactions will be low. Prices are sticky downwards, I once learned, when the pricing gets up, everyone again right away calls for higher prices. When it goes down, it takes a while, and it takes at least half a year or something like that to adjust for the prices. But during that time, we will have the restructurings, insolvency, and we have the refinancings on the non-stranded assets for the senior and less financing. So there's something to do, but different stuff.
Okay.
Different players.
Great. Oliver.
Yeah, obviously I have a slightly different perspective because for my clients, distress is positive. But this time around, it's not like in the early 2000s where a distressed debt investor would have a servicer who's going after every borrower and starts with foreclosure procedures and stuff like that. Next year we will have the directive on credit servicers and credit buyers implemented into German law. That's a must. And this clearly tells us we have to treat every borrower very fairly, and we have to try to find solutions. We have to try to find forbearance measures. It's more this time around. I expect it to be provide new capital into difficult situations where the traditional lenders are not going in there with new equity coming from private equity funds, and so we help. This part of the market also helps to build new stable investments in the market.
Okay, great. John.
Well, for investors, I would say the opportunities will be there who return to solid 10, 20, 30-year real estate investing, right? A long-term view, away from buy and flip models and speculative elements. From the lending side, the opportunities for us, that's the core of our business model, are where the traditional banks are not fast enough or don't want to lend for 3 or 6 or 7, 8 months. And that's probably going to increase next year as well. So those are the opportunities for us as a senior lender, right? And as I said before also, I think the home loan lenders, or those who are able to shift from mezzanine to the home loan focus, will have opportunities to expand themselves.
Okay, great. Deborah.
I think I've already answered that question. I mean, for us, I think, more refinancing opportunities next year, large size loans, interesting returns for our investors.
Great. And Irina.
Well, I think I'm a little bit biased, and I've given a little bit of insight at the beginning. So still financing that gap that traditional lenders have left for non-traditional lenders to step up is an opportunity. I think what I see also is that the non-listed equity players are recognizing that's the space they can easily tap into. They have been recognizing it for the last 3 or 4 years, but I think this will power charge that into action, I suppose. So I think that's, but from the kind of bigger picture side, I think it's all about bottom up and just looking at the asset by asset basis. Because I think, again, coming back to your point, there's so many moving parts that actually you have to go back to the fundamentals, including the big picture mega trends, right? To understand what is a good opportunity. And I think it's not a simple A or B answer. I think there could be a mixture of everything. So.
Great. Thanks very much to everybody for sharing your kind of views, insights on this, which I think is a really important area for 2023.